Hi guys, it's Kevin Al from Infinite Wealth. Today's video, part 4 in the series on the Wal-Mart Sam's Club 401k. We're going to go over the things that you need to do to maintain your portfolio over time. Welcome back guys, this is part 4 in the video series on the Sam's Club Wal-Mart 401k plan. Just to recap, in part 1 we went over choosing your asset allocation, which is the most important decision that you do have to make when starting your 401k. Part 2, we went through the different investment options that are available in your 401k plan. Part 3, we actually went through constructing your portfolio, custom tailoring it just for you, for your risk tolerance and your needs. And then today in part 4, we're going to go through the different things that you need to do to maintain your portfolio over time. If you haven't watched the first 3 videos, feel free to go back and check those out. There's a lot of good information on them. But on today's video, we'll be going through rebalancing your portfolio. That's going to help control your risk and control your return over time. We're going to go through the investment policy statement. I will share my personal one, give you some advice on writing your own. And then we're going to go into some backtesting programs that are available for free on the internet. These are kind of useful so that you can try out different portfolios, check your different percentages, see what they're going to do, what kind of result they're going to have on your final outcome on your portfolio. So let's go ahead and get started. We'll jump on the computer and start going through some of those things. Okay guys, here we go. On the rebalancing part of the 401k, okay, you'll log on to the benefits.ml.com website. You'll go into your account, then you'll go on the top bar investments, manage my investments. We'll bring you to this page here. There's 4 different choices. You'll be looking at review or reallocate my portfolio. Choose that we're going to do 401k. Depending on how long you've been with the company, you may or may not have the profit sharing plan. That was an older plan that the company used to put money in, whether you contributed to 401k or not. I don't believe they do that anymore, so if you're a newer associate, you might not have profit sharing. So if I actually am going to rebalance, it takes 2 days for me to do this. So on the first day I do the 401k, second day I would have to log back in, click profit sharing, and then do that one on the second day. So we'll just do profit sharing for this example. So you hit continue, and then you'll hit edit. Then if you look at your total percent of market value, this is the portfolio that you built in part 3 of it. So I did share my personal portfolio. So my BlackRock International Equity should be at 16. My Russell 1000 at 37. 2000 at 15. International equity is at 8. Small mid cap equity is at 4%. And bond fund is at 20%. You have to add up to 100%. This takes you back to your original allocation. So you hit continue, put in your password, and then at the end of the day when the market closes, it will sell the funds that you're over on, and it will buy funds that you're under on. I've just recently rebalanced, so I'm not going to do this today, but it would sell 0.23% of the Russell 2000 because it's above 15. It's going to buy 0.14% of Russell 1000 because it's below 37. Now you might ask, why do we do this? Well, the primary reason is your asset allocation determines 80% of your portfolio's return. So I try to keep mine as close to 80% stock, 20% bonds as I can. And then the other reason you do this is you're selling the investments that have went up in value and you're buying investments that have went down in value. Over time, if you do this consistently, this can increase your yearly return by as much as 1%, some studies have said. We will go over a little bit more about rebalancing in the investment policy statement section, but just keep in mind that this is a tax deferred account So when you're rebalancing, you don't have to worry about taxes or anything like that. So you can rebalance more often in this than some other accounts. Okay, next up, we're going to go through the investment policy statement. This is another important piece if you're going to do your own investing. If you're just first starting out, it can be a handwritten statement, and it can be very simple. It can be as simple as, I'm going to contribute 3% in my 401k this year. I'm going to bump it up by 1% every year until I get to that 6% match. And then just go through your asset allocation and where you want your assets to be invested in. And that should be good enough to start out. Over time, I've kind of developed mine to kind of encompass all my accounts and everything that you need to think about if you're running your own investments. So just really quickly, we'll kind of go through my investment policy statement. There might be some things on here you'd want to add in yours, and then other things won't apply to you. That's okay. You can have anything on your investment policy statement that you wish, but just make sure that when you're writing it, think things through, and this helps to keep you from making emotional decisions when it comes to investing. So first off, our philosophy, we would like a well-diversified, moderately aggressive portfolio with the minimal cost for each asset class we are invested in. We will manage it ourselves and keep it simple. We want to provide steady growth of capital, at least $120,000 in annual income after inflation and then taxes for retirement, enabling us to provide for our needs now and after retirement. Time horizon. We're long-term investors, so we understand that short-term drops in the price of individual investments can be sudden, severe, upsetting, but we are committed to focusing on the permanent growth of our entire portfolio rather than fixating on temporary declines of isolated investments. Since we intend this portfolio to last the rest of our lives, the investment horizon is 50 plus years. How the investments behave in a short-term matter much less to us than how they behave in the decades to come. For risk tolerance, as I've said before, I'm a pretty risk-tolerant investor. We will maintain an 80-20 stock-bond ratio, and this is for our 401k, TSP, and then we maintain a 70-30 stock-bond ratio in our Roth, rollover IRA, and taxable accounts. We hold the Roth, rollover IRA, and taxable account at Vanguard. With my 401k, it is in the Wal-Mart plan, and my wife works for the government, so she has the thrift savings plan. The amount of bonds will be adjusted up as we age and as we accumulate more assets. We will use the 110 minus age rule to set the approximate amount of stocks in the portfolio. And in the video 3, I explained the reasons why that I'm not quite at 110 minus age, or we're taking on a little more risk now. We're coming up on our yearly review. We're probably going to bump this up to 75-25 stock bond in the 401k and 65-35 in our Vanguard accounts for this year, just to let you know. Economic outlook. I don't rely on economic forecasts. While I remain modestly positive about the global economy over the long term, I believe that inflation will persist, and it poses the biggest threat to my long-term accumulated wealth. Taxes are the next biggest hindrance to our long-term wealth. On asset allocation, academic research suggests that the decision to allocate total assets among the various asset classes, stock, bonds, and cash, which we talked about in video 1, will far outweigh any security selection and other decisions on the impact of the portfolio performance. So after reviewing the long-term performance and risk characteristics of various asset classes, balancing the risks and rewards of market behavior, the following asset classes were selected to achieve the objectives of our portfolio. Emergency fund. We haven't talked about this yet on a video, but I will make a video about emergency fund. We have decided to maintain at least 6 months of expenses in a money market type of fund and up to 2 years of expenses in short government bond fund and money market funds for emergencies. This is separate and not included in the overall percentage of the asset allocations. So why do you do this? Well, we all know that things do happen. You might have a medical expense, your car breaks down, unexpected expenses do come up. we don't want to tap into our investments, especially if it happened to be a down year. So we just maintain a certain amount of cash to cover 6 months expenses. So first up, I'll just go really quick through the asset allocation. This is for our Vanguard account. So we have both of our Roth IRAs in there. My wife used to work for another hospital, so she has a rollover self-directed IRA. And then we keep our taxable money in there. So overall, we're at a 70 stock, 30 bond. Stock portion, we have 60% US, 30% international, 10% REITs. I did talk about this a little bit in video 3, but this is my actual allocation. And then bonds, you have more options in the Vanguard. So I have 50% US, 25% international, 25% in TIP, that's Treasury, inflation protected securities. Total stock market at 22%. I do tilt for value in Vanguard, so you can tilt for small and value. So I have a 10% large cap value. I have a 10% small cap value. Instead of doing total international in Vanguard, I split my Europe and Pacific evenly. So Europe is primarily the EU, European Union, and Pacific stocks are most of your Asian countries. Then I do tilt for small in my Vanguard account. So this is the International Small Cap Index. So this is all small companies outside of the US. And finally for Vanguard, I have a 4% allocation to emerging markets. Then next up, we have the REITs, that's Real Estate Equity Investment Trust. So I do, since I have a 70% stock, I do 10% of REITs, so that's 7%. So I have 4.5% in the Vanguard REIT index. That's primarily a United States index. Then I have 2.5% in the Global ex-US Real Estate Index. That's just a fancy way of saying that's an international real estate equity index. Last up, we have 30% for bonds. So I have 15% Vanguard total bond, 7.5% Vanguard total international bond. So that'd be bonds outside of the United States. And then 7.5% in short-term inflation-protected securities. We did go over this one in video 3. That's my personal allocation to the Wal-Mart 401k. And then if you actually look at my TSP allocation for my wife, it's essentially the same thing. So the C fund is like an S&P 500, so similar to a Russell 1000, 37%. There's no mid-cap option, so I just added the two together. So S fund is a small cap option, 19%. They only have one international option in the TSP, so that's 24%. And then there are several different bond options. So the F fund would be closest to the bond fund that we have, which is 15%. But then G fund is government security, so I just run 5% of that one. Then I included a chart with expected returns. So this has real return. So that's after inflation of 2.5%. So this would be the return you see on your statement. This real return is basically spendable money. And then relative risk. So this is how risky an asset is. And just for simplistic terms, as this number gets higher, that means that the risk is higher on your asset, and it will swing more widely in your return. So some years you're going to be up a lot, down a lot, so that is a lot more rocky road to get there. So if you look at the Treasury bills, the real return is 0.3. So basically you're barely keeping up with inflation. Relative risk is 2. We go through the rest of these. If you look at emerging markets, these are probably the riskiest assets that I invest in. Real return of 11%. After inflation, relative return 8.5%, and risk of 29. These are by far the most volatile markets. So some years you might be up 25, 30, 40% in emerging markets, but other years you might be down 30, 40, 50% also. So you just have to take that with a grain of salt. If you are willing to invest in them, you do need to make sure you're rebalancing. And then I actually have stated rebalancing procedures. So for 401k, TSP, they're both tax sheltered, so there's no tax implications to rebalance.
I rebalance once every quarter, so on 1-1, 4-1, 7-1, and 10-1, if any class is off more than 1% from the desired allocation. So for example, I have 20% bonds. If bonds are at 18.9%, I'd go ahead and rebalance the portfolio. Then I rebalance the Vanguard accounts that have the Roth, rollover IRA, and taxable account. When there's an absolute 5% from target, so that means if I have a 25% allocation, if it was less than 20 or higher than 30, that would trigger me rebalancing. And then if there's a 25% difference from the original target, so whichever is lower of the two. So for that example, if you had 10% allocated to international, your range would be from 7.5 to 12.5 because that's a 25% difference. So if you wanted 10% and it was at 7, you would rebalance back to 10. If it was at 8, I would just leave it alone and let it go. For the taxable account, I don't automatically reinvest dividends and interest, so they go to the cash account. And then when we put new money into taxable, we lump those in to rebalance. Taxes are always a consideration, so only sell funds that have long-term capital gains if possible. So those are funds you've held for at least a year. Currently, that rate is 15%. If you do not hold something for at least a year, you will pay your normal percentage tax rate for federal. Stock bond mix is the primary determinant of the risk and return of the portfolio. So I try to maintain that as close as possible. So I try to keep it as close to 80-20 and 70-30 as possible. And then I just went through and calculated out rebalance bands just so they're in here so I don't have to think about it. The 22% in the total market and the S&P 500, that is the only one that comes to the 5% rule. So between 17 and 27, so it can float. Everything else is the 25% from original. So you just take that difference. So for an easy example, target is 10. 10 times 0.25 is 2.5%. So you have 7.5 to 12.5 is how I calculate those numbers. We'll skip over tax loss harvesting for now. Just keep in mind you can do that in your taxable account if we do have a market downturn, and that can save you some money on taxes. Next up is market timing. We dollar cost average in our 401k, so you're putting money in every 2 weeks. So you don't have to worry about market timing. Just keep in mind that nobody knows where the market's going to go. It's either going to go up or down. We have no control over that. We have no way to know. So that's why we have this investment policy statement that it tells you exactly what to do. I review it annually. I'll just go through the excluded classes of things I do not invest in. We don't invest in long-term bonds. We try to keep the bond duration to 10 years or less. I do not invest in corporate bond funds. Those have stock-like risks with bond-like returns, so that's just not a good investment for you. Do not invest in options, futures, commodities, precious metal funds, limited partnerships, or hedge funds. Next up is tax policy. This is advanced. We'll just leave it at, we go from very efficient to very inefficient. So we make sure anything that is an active fund, a REIT, active stock funds, bond funds, we make sure those are in tax sheltered accounts. So the only thing I invest in the taxable accounts, those are accounts you pay tax on every year, are the large cap and total stock market index funds, domestic and international. I have plenty of room in my tax sheltered funds to invest in everything else I want to invest in. So that is it for the investment policy statement. I know it is quite a bit. This has developed over the last 10 years for me. Like I said, if you're just starting out, if you only have 10,000 in your 401k, 1,000 in your 401k, or you're just starting out, just a very simple written investment policy statement should be plenty for you. So at the minimum, you want to have what your asset allocation is, what you're going to invest in, and rebalancing procedures. And then probably what percentage you're investing and how you're going to increase that investment over time. Okay, so that is it for the investment policy statement. Okay, next up we're going to go through just one of the free tools that's available to you on the internet. This is a pretty good basic website to play around. It is portfoliovisualizer.com. I'll put a link to this in the description. There's several different things you can do on here, but today we're just going to look at a back test of portfolio. So as you're designing your portfolio, you can use this section to put in your portfolio, put in a few different types of scenarios just to see how it's performed in the past. So what we're going to do is jump over to an example for mine. I just picked arbitrarily a start year of 2003. I probably did have around $10,000 in my 401k at that time. Putting in about $2,200 a month with the company match. We do max out our 401k and TSP, which is right now is $19,000 a year. I put in for a quarterly rebalance, and then the benchmark that I put in is the total stock market. So that is a Vanguard fund. What you'll do for this is you won't be able to find the exact funds, but if you type in Russell 1000, you know that ours is a iShares Russell 1000 for 401k. So this one here will be pretty close. So that is the Russell 1000 ETF. So that's pretty close. You won't be able to find exactly what it is. So that's the Russell 1000, Russell 2000. They didn't have anything that matched the small mid equity, so I just picked a Vanguard mid cap equity fund. And then BGY is the BlackRock International Equity. They didn't have one that matched the International Equity Fund, so I just put all the international into that. And then AGG is the closest thing that matches the bond fund. So AGG is the iShares Core US Aggregate Bond Fund, and that is pretty close to our bond fund. So this first portfolio you'll recognize, it's my 80-20 portfolio that I shared with you earlier today and in part 3. And then I made a 70-30 and a 60-40. So then all you'll do is you'll hit Analyze Portfolios. Brings up a nice pie chart to compare the two. So the purple color here is bonds. So that's 20%, 30%, 40%. So as you add more bonds, it should add less risk into each portfolio. And then it does give you kind of a nice, you can see the difference in the pie chart of what you're investing in. As you see, this does give you kind of an approximate idea of where your portfolio is going to go. It's not perfect by any means. And with my assumption, I guessed I had about 10,000 in 2003. As you saw on the benefits.ml.com website, I had 412,000, I believe, today. This one's predicting 519,000. So that's really pretty close over the span of time. You can see in the different portfolios, this is an 80-20, so you end up with more money. Portfolio 2, it's got more bonds, so you have less return, so that's a little bit less. This number here is kind of misleading because this is from 2008, and if you remember back to 2008, this was the financial crisis. This was the year where the total stock market was probably at the lowest it's been, and over the last 10 years, it's done extremely well. So if you look at the green on this chart, that's if you had a 100% stock portfolio. Do keep in mind, though, that that is not a typical result. In general, your other portfolios over time would be a little bit closer to that. So then a few numbers that we want to look at on this. Standard deviation, that tells you the volatility of your portfolio. So in simpler terms, the lower the number of the standard deviation, the less your portfolio is going to vary in market swings, either up or down. So if you look, the most risky portfolio, 100% stock, is your Vanguard total stock at 15.69. My 80-20 is at 13.36. 70-30 is at 11.77. 60-40 at 10.18. So you can see that as you have more bonds, it's going to become less volatile, your portfolio. The flip side of that is your best year. It will be the highest in a total stock market fund almost every time. Then as you go add in more bonds, your best year is down and down. And then on the other side of that, your worst year, if you have a 100% stock portfolio, you're looking at a 37% drawdown, whereas your 80-20 only has approximately 30%. So if you look at the worst year here, you'll see that the 100% stock portfolio is the one that has the most potential for loss. And as you go increasing your bonds, you're going to lose less and less. If you look at the max drawdown, that's an important one to look at as you play around with these numbers. That would mean your $100,000 portfolio goes to $52,000. Not a lot of people can stomach that. Then if you look at my 80-20, $100,000 goes to $60,000, and then all the way down to a 60-40, where $100,000 goes to approximately $70,000. So you are losing less money in a max drawdown, like terrible market situation. My advice for you is to look at this number, think of it in terms of $10,000, $100,000, or $1 million. So if you had $1 million, would you want to watch your account go to $520,000 over a year? If you don't, that means that you need to add in more bonds. So then finally, this will give you your annual returns over the years for this portfolio. So my portfolio did lose money in 2018, as did most people's. And that is about right. It probably lost about 8%. So that's pretty close. So far in 2019, I'm up 8%, which is approximately what I lost. So I'm kind of right back to where I started at the end of 2017. But if you kind of look at this over time, 2008 was obviously a bad year for everyone. But then look at how it bounced back in 2009. And this chart is pretty representative. In general, you should expect to lose money in the stock market 1 out of every 3 years. So if you look at this is 10 years. It's showing basically 1, 2 years where you lost money, 1, 2 where you lost money or barely made any. So that's 4, and then you have 6 years where you actually made good money. Some of the best money that I've ever invested in my entire lifetime was money that was put into the market in 2008 because the valuations were so low. I bought more shares, and then as time went on, that's turned out into so much money for me over the years. So this is the basic overview of how to backtest your portfolio. You don't want to put a whole lot of stock into it, but this is something good for you to do if you're going to run your own portfolio. I did this several times before I came to my final portfolio, just kind of messing around, changing the numbers, see what it would do. This is really a useful exercise, something good to spend a little time on. That way you make sure that you get your asset allocation and all your investment options right for you.
Okay guys, I know we went through a lot of information today. If you do have any comments, please leave them below. Also, if you have any ideas of things that you want to talk about for future videos, just leave those also below. I know that a lot of this information is kind of hard, especially if it's new to you, but I've tried to keep it simple, break it down into normal terms that everyone can understand. The amount of time that you put into your portfolio in the beginning will be a big factor of how big your portfolio grows to in the future. So you definitely want to spend some time learning about these things, keep studying them, and then make sure that you pick the portfolio that's right for you. Since we do get paid every 2 weeks, I am investing money into the 401k every 2 weeks. I do spend about 30 minutes one time every 3 months just to rebalance the 401k and the profit sharing portion of the portfolio. Other than that, there's really not a lot that I do. I review my investment policy statement once a year, and then if we make any changes, we try to make small changes. One of the key takeaways I try to stress here is you want to save as much money as possible for as long as possible. So they always say it's more important to have time in the market than trying to time the market. So don't worry if the market's up, if it's down. Just save money every 2 weeks. Try to get to at least the 6% match where you're getting the free money from the company for their 6%. So that's 12% of your income. Once you do get to that 6% match, my suggestion would be to open up a Roth IRA max that out. Currently in 2019, you can go up to $5,500 in a Roth. Then after that, come back. If you have money left in your 401k, you can invest up to $19,000 per year in the 401k. So that would be the path that I would take for all of you. After you get all of those filled up, if you still have extra money to invest, then you want to go with the taxable account. Again, thank you for your time. Thanks for watching this video. I really appreciate you hanging with me all the way to the end here. Feel free, like the video, subscribe. I'm going to be doing a lot more leadership and investing videos here in the future. And thanks again for watching.
Tell me pretty lies, look me in the face. Tell me that you love me, even if it's fake.